You know, if you ask someone on the street to picture a global mobility company, 9 times out of 10, their mind immediately conjures a very specific, almost cinematic set of images.
Oh, absolutely. Like a worn leather jacket.
Right. Exactly. A leather jacket, the aggressive roar of a combustion engine, two wheels just tearing down a winding coastal highway. It is an image that feels, I don't know, incredibly grounded, very gritty, and deeply tied to this visceral, emotional brand identity.
Yeah, and it is a phenomenal piece of brand conditioning. I mean, the market basically categorizes them strictly as a motorcycle manufacturer, prices in all the assumptions that come with a consumer discretionary hardware business,
Yeah.
and then, completely moves on.
But then you actually lift the hood on their balance sheet. You start tracing where the cash is really coming from, and suddenly that leather jacket just disappears.
It completely vanishes.
Right. It gets replaced by like the gentle lap of waves against a luxury yacht off the coast of Florida. Or, even more surprisingly, it gets replaced by the hyper-sterile robotic hum of a semiconductor manufacturing floor in East Asia. We are looking at a corporate reality that is entirely at odds with its public perception.
Yeah, we are talking about the absolute definition of a diversified industrial giant hiding in plain sight. If you only look at the marketing, you totally miss the actual economic engine.
Welcome to this special Japan Stock Podcast edition of our Deep Dive. Today our mission is to unpack a real-time corporate drama of survival, adaptation, and really ruthless pricing power. We're looking at Yamaha Motor Company.
And the story here is just phenomenal.
It really is. We are going to explore how a company famous for street bikes actually pulls a massive chunk of its operating profit from high-end watercraft. And more importantly, we're going to look at how they weathered this brutal, multi-front geopolitical storm throughout 2024 and 2025 to mount a fierce, incredibly calculated comeback in early 2026.
Right. And to really understand this, we have to strip away the romance and look strictly at the numbers. Like, if we apply a rigid 80-20 rule to their revenue and profit generation, well, those preconceptions have to go immediately.
So what does that actually look like on paper?
Yamaha Motor is fundamentally driven by two core pillars. That's the motorcycle segment, which we'll just refer to as MC, and the marine segment. But the critical piece here isn't volume.
Wait, what do you mean it isn't volume?
I mean, they aren't trying to sell a bike to every single person on Earth. It is entirely about a hyper-targeted premium strategy.
Okay, let's unpack that premium strategy because, premium is a buzzword every single company uses. What does it actually mean for their bottom line?
Well, in developed markets, particularly the United States, the marine division is laser-focused on large outboard motors. We're talking about massive engines pushing 150 horsepower and up, with a heavy strategic emphasis on their new 350 horsepower F350B model.
Oh, wow, so these are huge.
Yeah, exactly. These aren't for casual weekend fishers in a little rowboat. These are for serious, high-end recreational boating. And then in emerging markets, the premium shift looks a bit different. They are pushing high-end, feature-rich scooters like the NMX and AROX, actively shifting consumers away from basic commuter mopeds.
So if I'm visualizing this for everyone listening, on the surface they sell bikes, but underneath, the financial engine is basically selling high-margin luxury real estate on the water in the U.S. and connected digital status symbols on two wheels across Asia.
The data completely backs up that intuition. I mean, the marine segment, particularly those large outboard motors, is characterized by incredibly high barriers to entry.
Because it's hard to build them.
Exactly.
Yeah.
It requires immense capital to develop a reliable 350 horsepower engine. And because of that, you see intense brand loyalty from the actual boat builders, which gives Yamaha immense pricing power.
Right, that makes total sense.
But to really understand why their current position in early 2026 is so compelling, we have to examine the absolute gauntlet they ran over the last 2 years.
And calling 2024 and 2025 a gauntlet is almost an understatement. Reading up on this, it felt like they were getting hit from every conceivable angle. Let's start with the macro shocks, because the external environment was just hostile.
It was a cascading series of severe external shocks. At the macro level, you had massive U.S. tariff hits. Early projections estimated those tariffs would wipe out 50 billion yen from their operating profit.
That is insane.
Right. Think about that. Just overnight, policy friction threatens to erase 50 billion yen. Then, in the third quarter of 2025, the pressure broke through the hull. They had to take a harsh impairment loss at their U.S. recreational vehicle factory.
Now, I want to pause on that impairment loss. From a strategic perspective, impairment loss usually means management is admitting, hey, we built this factory anticipating a certain level of demand or pricing, and we were wrong. So what went wrong in the U.S.?
It was a toxic combination of fierce price competition from rivals and massive excess inventory in the U.S. market. The consumer cooled down, the dealer lots filled up, and Yamaha basically had to swallow the bitter pill of writing down the value of that facility.
Ouch.
And frankly, the bleeding wasn't just contained to the U.S. They faced severe excess inventory globally in their smart power vehicles. Think e-bikes.
As if the macroeconomic environment wasn't punishing enough, the physical supply chain issues read like bizarre, localized fiction.
I was looking at the notes on Brazil, an Amazon River drought. Walk me through how a drought stops a mobility company from building units.
It really highlights the extreme fragility of global supply chains.
Mm-hmm.
Yamaha is a massive manufacturing hub in Manaus, Brazil, which sits in a free trade zone deep in the Amazon. It relies almost entirely on river transport.
Wow, okay.
Yeah, so barges bring in the raw materials and components, and barges take out the finished motorcycles. Well, in 2025, a historic drought dropped the water levels so low that the barges simply couldn't move.
Oh my God, so the factory just stopped. The factory literally starved for parts, forcing a complete production halt. Combine that with severe floods in Vietnam, entirely disrupting their Southeast Asian operations, and you have a logistical nightmare.
When you lay it all out like that, the tariffs, the U.S. factory write-down, the inventory glut, the literal rivers drying up, it makes sense why we saw what happened next. For a retail investor watching this unfold in real time, the alarm bells were deafening.
Oh, absolutely.
It culminated in a painful dividend cut in 2025. Now, I have to push back here. When a legacy company slashes its dividend, that is universally seen as a massive red flag. It signals cash flow panic. So why shouldn't an investor have just run for the hills?
It's a totally fair question, and understandably, the market reacted poorly initially because profits did dip below their internal financial health targets. But this is where the narrative shifts. This is where we see how corporate scars force the creation of corporate armor.
I like that. Corporate armor.
Management realized their operating leverage was wildly overexposed to external volatility. They couldn't control the Amazon River, and they couldn't control U.S. trade policy. So instead of going into a death spiral, they used the cash saved from that dividend cut to force a brutal structural metamorphosis.
Meaning they had to radically change how they made money, not just how much they made. How did they actually do that? Like, structural reform's a great buzzword, but what were the actual mechanics?
They ruthlessly lowered their break-even point to the 70 to 80% range. And the mechanics of this are fascinating. They didn't just blindly fire people. They fundamentally changed the product mix.
What do you mean by that?
Well, if you sell 10 budget motorcycles at a tiny margin, you need your factory running at 100% capacity just to keep the lights on. If demand drops 20%, you bleed cash. But if you pivot hard away from low-margin units and focus exclusively on premium models like the AE-ROX, your profit per unit skyrockets.
Oh, I see.
You are actively accepting lower total volume on the factory floor in exchange for much, much higher profitability per unit.
So they essentially build a cushion. If another shock hits and sales drop, they don't immediately slip into the red because each unit sold is doing so much heavy lifting for the bottom line.
Precisely. And they accelerated deep, painful structural reforms, specifically in those bleeding U.S. operations. They audited model development, slashed redundant costs, and leaned out the entire manufacturing process.
Which brings us to the payoff we are seeing in the deep dive materials from the first quarter of 2026. The rebound is incredibly aggressive.
It really is.
Looking at the numbers, that U.S. facility alone, the one that took the brutal impairment charge, is now targeting a 37 billion yen profit improvement for the 2026 fiscal year. That is a massive swing, and the tangible proof for anyone holding the stock is that management has promised to return to a 50 yen dividend.
We need to explicitly map out how this underlying financial causal chain works, because it's the absolute key to their 2026 valuation. In 2024 and 2025, the surge in raw material costs, massive labor inflation, and those looming tariffs directly compressed their gross margins. It cost them more to build the product, but they hadn't raised prices yet. That dynamic absolutely crushed their earnings per share.
It's the classic margin squeeze. You're paying more for steel and labor, but the price tag on the showroom floor hasn't changed.
Exactly. But by forcing that higher mix of premium models, pushing those massive F350B outboards and the connected NMAX scooters, they structurally expanded their profit margins.
Because there's more room to raise prices.
Yes, a premium product inherently absorbs higher input costs better than a budget product. A customer buying a luxury yacht engine is far less sensitive to a 5% price hike than a customer buying a basic commuter moped. Once Yamaha successfully passed those adjusted costs onto the consumer, their operating leverage flipped. EPS isn't just recovering, it's rebounding sharply.
And that flows directly into their medium-term targets, which honestly look very ambitious given where they were a year ago.
They really do. They are targeting a core return on sales of over 10% in motorcycles and an incredibly robust 20% plus return on sales in the marine segment.
No, 20%.
Yeah, keeping 20 cents of operating profit on every single dollar sold in the marine division gives them massive breathing room. This is all engineered to drive an overall corporate return on equity, or ROE, of 14 to 15%.
And for you listening, an ROE of 13 to 15% is the gold standard indicator of a highly efficient use of shareholder capital. It means management isn't just sitting on cash, they're actively compounding it at a high rate. But we can't talk about EPS and pricing power without talking about the geopolitical chessboard. Let's look at their global exposure, starting with the United States.
The U.S. market has been the absolute epicenter of both risk and relief for Yamaha Motor. From a clinical perspective, high interest rates heavily chilled the middle to small outboard motor market.
That makes sense.
When financing costs spike from 3% to 8%, the casual middle-class boater simply pulls out of the market. Furthermore, the U.S. tariff situation under the evolving political landscape, often referred to as the Trump effect regarding trade protectionism, was a massive, suffocating headwind throughout 2025.
Just to be perfectly clear to everyone listening, we are looking at this strictly through the lens of corporate data. We aren't making any political judgments or taking sides. We simply observe the impartial business facts. And the reality on the balance sheet was that the looming threat of massive protectionist tariffs was suffocating their U.S. profit projections. But then, in early 2026, the chessboard shifted entirely.
It was a massive pivot. In February 2026, the U.S. government dropped a specific tariff rate affecting Yamaha's imported products from 15% down to 10%.
Which is huge on its own.
That alone was a breath of fresh air. But the true unexpected reprieve arrived in April 2026, when outboards and motorcycles were explicitly excluded from the broader U.S. steel and aluminum tariffs.
This is such a crucial point. If you think about what we discussed earlier, the structural reforms, the lowering of the break-even point, they basically spent 2025 building a lean, heavily fortified bunker to survive a 15% tariff war. And then the war ended. Now they get to operate that incredibly lean, highly efficient machine in a much friendlier tariff environment. That acts as a massive upside catalyst for the second half of 2026.
The leverage is incredible. Every dollar saved on tariffs drops straight to the bottom line because their cost structure is already so lean. But if we pull back and look at the global footprint, it highlights the vital importance of their segmented diversification.
Right, because not everywhere is experiencing the same macro trends.
Precisely. Because while the U.S. was a tariff battleground, their strategic business segment, specifically robotics, was dealing with an entirely different macroeconomic reality over in China.
Okay, let's transition to the robotics division, because this is the part of the deep dive where the identity of the company gets completely flipped on its head.
Yeah.
If you thought they just made boat engines and dirt bikes, this is where it gets really wild.
Initially, the story here looked quite bleak. Their surface mount technology business suffered heavily due to a sluggish Chinese economy.
And what exactly is that technology?
Rather than using the acronym, think of surface mount technology as the giant, ultra-fast robotic arms that literally slam tiny electronic components onto printed circuit boards. It's the baseline manufacturing for consumer electronics.
Got it.
So when the Chinese manufacturing sector slows down, orders for these massive robotic arms drop. However, a fascinating countertrend emerged within their semiconductor back-end processing division.
Here is where it gets incredibly interesting, especially if you're trying to figure out how to play the tech boom without just buying the obvious megacaps.
Yeah.
What are they doing in semiconductors?
Well, the global boom in generative AI didn't just accelerate demand for software, it massively accelerated demand for advanced physical semiconductors. And those specific AI chips require highly specialized back-end processing.
Okay.
We are talking about precision machinery like flip chip bonders and molding machines. Because Yamaha already mastered high-speed, high-precision robotic placement with their circuit board machines, they easily transitioned that tech into the AI chip space.
That is so smart.
They are actively capturing this wave, securing major automotive and electronics manufacturing clients. Their stated goal is to become top 3 in this industry, aiming for a 15% to 18% compound annual growth rate by 2027.
If you're tracking the AI gold rush, everyone is looking at the primary chip designers or the big server farms. But Yamaha Motor is quietly functioning as the ultimate pick-and-shovel play. They are selling the incredibly complex robotic tool required to physically assemble the hardware that powers artificial intelligence. It's brilliant.
It really provides a massive high-growth counterbalance to the traditional cyclicality of their recreational mobility businesses. But, even with the excitement around AI robotics and luxury yachts, we cannot overlook their true volume driver, which remains the emerging markets.
Right. High margins are great, but the sheer volume of humanity moving around on a daily basis in Asia is staggering.
Yeah.
What is the state of play over there?
Let's focus closely on India, Indonesia, and the Philippines. We are witnessing a profound demographic and economic shift. The upper middle class in these regions is expanding rapidly, and Yamaha's strategy here is vital to understand. They're no longer just selling a cheap metal frame with wheels to replace a bus ticket.
Right.
They are selling premium connected experiences.
They're selling a lifestyle. They're basically selling a digital status symbol.
Absolutely. Now, they did face some friction in India in 2025. Macroeconomic tightening led banks to enforce really high loan rejection rates among younger buyers.
So interesting.
Basically, the youth wanted the premium scooters, but the banks wouldn't finance them, which temporarily bloated inventory. But here is the critical takeaway. The underlying organic demand for these premium status symbols remains ironclad.
So people still want them.
Exactly. Yamaha is heavily pushing connected features, aiming to build an ecosystem with millions of digital IDs, literally linking the physical scooter to a rider's smartphone and digital lifestyle.
They are trying to turn a one-time hardware purchase into a sticky software relationship. I mean, if my scooter tracks my maintenance, maps my routes, and acts as a social identifier, I'm significantly less likely to switch to a rival brand next time.
Precisely.
And what about Indonesia? Because the demand curve there was completely different from India's recent hiccup.
In Indonesia, the dynamics worked heavily in their favor. The delayed introduction of a local tax policy, which is known as the open tax, drove an unexpected and massive surge in demand in the first quarter of 2026.
The sort of buy it before the tax hits rush.
Exactly. Consumers rushed to buy before the tax hit. Their premium automatic scooters, specifically the NMAX, virtually flew out of the dealerships. This massive volume of premium sales allows them to maintain that critical 10% plus margin in the motorcycle segment. The overall corporate profitability is heavily subsidized by this emerging market premiumization.
Okay, looking at the entire board, let's pull these threads together. When you take a step back, Yamaha Motor's story over the last 2 years isn't just about motorcycles or boats. It is an absolute masterclass in how a global manufacturer navigates sheer chaos.
It really is.
They faced raw material inflation, unpredictable climate events that literally dried up their supply routes, and intense politically driven tariff wars.
And their response was the textbook definition of corporate resilience. They didn't panic. They flexed their pricing power because they had built premium products people actually wanted. They rigidly focused on high-margin segments, large marine and premium motorcycles, and they executed ruthless, painful structural reform when their U.S. operations started bleeding cash.
For you listening, whether you are a retail investor poring over balance sheets trying to find an edge, or just someone trying to understand how massive companies survive a volatile global economy, there's an invaluable lesson here. Watching how management takes external scars, like a threatened 50 billion yen tariff hit or an Amazon river drought, and turns them into margin-protecting armor by structurally lowering their break-even point, well, that is the absolute essence of long-term value creation.
They really transformed the business.
They didn't just survive the storm, they re-engineered the ship so it sails faster now that the water is calm.
Which leaves us with the fascinating forward-looking question, one that challenges their traditional identity entirely. As Yamaha's core mobility businesses, the motorcycles and the outboards, stabilize in this new, leaner format, what happens next?
Right.
If the generative AI infrastructure build-out continues its explosive pace globally, could their relatively under-the-radar robotics and semiconductor division eventually eclipse their mobility roots and become the true engine of their future valuation?
It makes you wonder. The next time you hear a motorcycle engine roaring down the street, you might just be listening to the cash flow that's actively funding the high-speed robots building the next generation of artificial intelligence. Thanks for joining us on this Japan Stock Podcast Deep Dive. Keep questioning the data, look past the public perception, and we'll see you next time.